This is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I am Alex Tapska here with co-host Andrew Young. How are you doing today, Andrew?
Doing pretty well. Looks like crypto markets, we had a little bit of a bounce yesterday and then immediately gave up all of those gains again. So
yeah, it's another patriotic, freedom-loving rally in Bitcoin on July 4th, followed by the painful hangover. We saw the same thing happen on Memorial Day. It's like everyone eats hot dogs and gets drunk and buys crypto, and then the next day they realize what they've done and sell it. It seems like the narrative on the macro side has changed quite dramatically overnight. We've been talking about inflation fears and what impact that's going to have on risk assets and rising rates and all that. And those things may not have changed, but we've added this new dimension, which is that we're definitely going into a recession, or at least that's the consensus amongst economists. Over 70% of economists expect the US to go into a recession officially this year, which is simply 2 consecutive quarters of negative GDP growth. We already had one, so it's really just one more to go. Today, we are recording this. It's Tuesday, July 5th. We saw the biggest sell-off across the entire commodity complex since 2011. So on average, everything from industrial metals like copper to oil and key inputs into the economy have sold off, which is generally a sign, of recessionary fear. The one notable outlier being natural gas, mostly because there's fear that Russia is going to cut that off from the rest of Europe. But putting all of that aside, it's kind of difficult to try and figure out, well, how does crypto factor into, a market that is dealing with all of these different kinds of factors? So far, it seems like we're kind of holding this $20,000 level in Bitcoin, and a lot of these other assets seem to be finding a range, but we've seen that before and things can either break down or break up. So what's your take right now on the macro situation?
Yeah, totally. I mean, so one of the things I've been tracking is the Atlanta Fed Now, which releases essentially they're called nowcasts. So estimates of what the next GDP print will look like. And what's interesting is over the last 3 months, it's essentially fallen off a cliff. It started off at around 2% expected real GDP growth for Q2. And then it's been steadily declining. And then I think on our last podcast, I think we talked about how it had hit effectively 0%. And then now the most recent update, which came on Friday, is now negative 2.1%. So it dropped quite dramatically from over the last couple of weeks. And I was looking into it, and essentially the largest, this is an estimate, obviously, so there's some errors with it, but it's incredibly rare for you to see a 2% error rate. Typically, the error rate's around 0.25 to 0.4%. So bearing a massive error in the forecast, we are effectively going to be in a recession as of the next GDP print, if not already.
Yeah, to say we're in one now, right? Because the next print is a lagging indicator. It's the print for the quarter.
Yeah, exactly. So one thing to keep in mind, though, is this is real GDP. So the nominal GDP rate is actually still quite high, given that we're having 9% inflation. The nominal growth rate is still 7%. So again, on the surface, I think a lot of people would say things are going reasonably well, but it's more just if you look at real GDP, the picture is a lot bleaker. I'm also seeing a lot of stuff on housing. I've seen a lot of stuff saying that inventories in both the US and Canada are creeping up quite a bit, and housing is likely going to take a turn for the worse. That makes sense given the increasing interest rates. I think overall, the macro picture is a little bit bleak, at least in terms of economic growth. With that being said, obviously everything's looking at inflation, and we still haven't seen a reversal of China's COVID zero, nor have we seen really any progress towards peace in the Russia-Ukraine war, which are really the 2 biggest factors driving what is currently supply side inflation. So overall, I think we're sort of heading towards, I guess, stagflation, unless we really hammer the demand side with further rate hikes, which I think a lot of people are expecting. I don't like, that's kind of just my macro take. Macro has obviously been dominating the headlines the last couple of months. Curious what your thoughts are, given everything.
Yeah, well, we're not a macro podcast, and there's some pretty smart people who spend all their time looking at this. So I feel like you and I spend a lot of our time looking at this. They say the cure for high gas prices is high gas prices, right? Like which is another way of saying at a certain point, you can have demand destruction that's caused by high inflation, especially in key inputs like energy. But also with the rate environment that we're seeing, I think you are seeing a lot of this demand destruction. I hope, but we'll see. Like, I hope that when we do see the next print, core inflation probably still be high because of food and energy. But if you look beyond that to a lot of goods and services, especially on the goods side, I think it's going to be rolling over really, really hard. And you'll see that appear, you're already seeing that appear in the high inventory numbers that you're describing and some of these other sort of early indicators. So what does this all mean for crypto? I don't really know, to be honest with you. I think we're in this period where, consumer confidence is shaky. There was a poll out that, 80% of Americans think the country's headed in the wrong direction. And I don't know if that means that they're, that interested in engaging in, investing into early stage growth things, which is what I think of crypto as. But the counterpoint to that is that, a lot of the innovations of DeFi and Web3 are things that are not so much financially driven as user driven and driven by utility. And I think as the technology matures and as this crypto winter that we're in produces new and interesting applications and use cases, that you may see the sort of early adopter consumer side driving the marketplace, just as we saw in previous cycles. It was in the summer, I believe, of 2019 when DeFi really kicked off. That sort of happened quietly, but then gained steam. So we could start to see something like that happening during this crypto winter that we're in as well.
Yeah, totally. I mean, we kind of have to cover the macro environment a little bit, just given how important it is to the direction of crypto prices. I mean, not to spend too much time on it, but I do think one of the big sort of outcomes of this macro-driven market is that it's really killed the narrative that Bitcoin and crypto assets are an inflation hedge. They are definitively not an inflation hedge. They are clearly trading more like very high risk on assets, like essentially small cap technology stocks.
Well, I think that's true for most crypto assets. And I think that the problem with investor narratives or narratives in general is that there are certain attributes that Bitcoin has which make it similar to gold, namely that it's not created by a government and that there is a relatively, limited fixed supply and that it takes sort of time and energy to produce. All of those things are true of Bitcoin and they're also true of gold. And so there are some similarities. Having said that, Bitcoin has a shorter track record, doesn't yet have, 10,000 years under its belt as acting as an alternative asset. But I think over time, it actually could inhabit that role. But the similarities basically end with Bitcoin. Most of these other crypto assets are much more, to your point, like buying investments in early stage businesses. And even the larger ones like Ethereum, I think are more like a FANG stock than anything else. I mean, Ethereum is quite similar to a Google or an Apple in a way. It's a platform that has an application ecosystem that gains in value. The more applications are built on it, the more people use it, not unlike, the iOS store, Android, or any of these other kinds of platform businesses. But then once you get beyond that into the smaller names, they're nothing like currency hedges or inflation hedges. And I don't think anyone, at least not me, has ever suggested that they are, right? Once you get down into the small cap and micro cap crypto assets, I mean, how could they be an alternative to, liquid fiat market? They are small, emerging, and exciting things that have the potential for huge asymmetric returns, as we've seen over the course of this asset class, but in downtrends can have, significant drawdowns, as we've seen in a lot of high-flying stocks, and including a lot of big brand names, like Shopify, Netflix, PayPal, and countless others, right? So I think it's important to distinguish between the two, but even still, Bitcoin has not demonstrated itself at all. It is as a currency hedge in this current downtrend. It is much more like a FANG stock, frankly, and its chart and beta and correlation and everything actually basically looks just like one of those kinds of assets.
Yeah, totally. And I think with that sort of theme, what's interesting is one of the sort of hedge funds that banked the most on it being both kind of a inflation hedge and not sort of just a risk on asset that's subject to the sort of traditional whims of risk on, risk off markets is Three Arrows with Sue's super cycle thesis, which was essentially that crypto assets weren't going to have a bear market. They were going to be essentially a straight line upwards due to both rising inflation and also just accelerated adoption of the asset class. And I want to flag Arthur Hayes' recent blog post. So Arthur Hayes is the founder of BitMEX. BitMEX, along with FTX, are the two largest perpetual derivative exchanges in the world for crypto. I think they trade literally trillions of dollars per year. And he has been writing, he's essentially become one of the most prominent market commentators in all of crypto because he comes from a currency trading background. So he brings kind of a traditional finance take to, along with obviously expertise in the crypto markets. And he actually did sort of a postmortem on the Three Arrows collapse. And what was interesting is essentially his take was that the Three Arrows guys, for the most part, started with the cash and carry trade on using things like BitMEX. So just to give like a quick overview of that, the cash and carry trade is essentially historically these perpetual derivatives in crypto have historically paid shorts. So people who, because there's a long bias in the crypto market. So what you could do as a trader is you could essentially short these perps and then buy the spot and effectively be hedged. And what's interesting is the Three Arrows, according to him, started with that and then essentially fell in love with this idea that crypto assets were only going to go up in price and started taking directional risk on crypto markets. Yeah. Particularly in alternative layer ones like Avalanche and Terra. And then as well as like a number of sort of private tokens. And then they also, they went really heavy on the Terra Luna UST sort of anchor trade. So essentially Anchor Protocols, if people don't know, was a lending platform built on Terra Luna. It paid a fixed 20% yield on all the money that you put into it. So apparently what Three Arrows was doing was they were taking out tons and tons of debt from all of these lending platforms. So BlockFi, Celsius, pretty much you name it. Voyager was another one. And we're essentially paying Voyager typically sort of 10 to 12% yields, which those lending platforms then passed on to their own customers. And then took that money and essentially put it into Anchor Protocol to earn a 20% yield. And essentially just clip that 8% spread. The problem is that Three Arrows was so well known and seen as such a sort of gold-plated borrower, given their prominence within the crypto market, that a lot of these lenders began just essentially giving them unsecured loans. Voyager was sort of the number one victim of this. So essentially they were completely unsecured loans just based on the fact that Three Arrows was this very prominent hedge fund. And so then when Terra Luna collapsed, Three Arrows was essentially insolvent, which has then led to this sort of financial contagion. But what's interesting is that he estimates that the total book size was maybe up to $20 billion because they had taken out so much leverage. And so anyways, it's very interesting. I mean, we've talked a lot about Three Arrows, but it shows you that essentially risk management or trades in crypto, similar to traditional finance, can get highly, highly crowded, which then effectively is the recipe for a major blow up. And
Yeah,
one last,
and it's a huge deleveraging cycle too, because we have to work through all of the loans that, were made to a company which can't pay them back, and all of, when a company makes a loan, then it has to call a loan, then it has to raise capital, then it's got to, wind down its loan book. And there's all these things that have to happen basically for this deleveraging cycle to sort of come to an end. And with no lender of last resort in the traditional sense, meaning like a government or central bank, it's up to the industry to fill that gap. And we've seen that with SBF. We talked about that a lot recently. In fact, I think we were probably some of the first people to bring this up, this comparison to the panic of 1907. I think we made that comparison months ago when things were really starting to show signs of strain in this marketplace. And I actually decided to finally put pen to paper, and I wrote it up as an op-ed for Fortune magazine last week, and it's received pretty widespread reach, which has been kind of interesting. People really resonating, that metaphor is really resonating with people. But yeah, I mean, we'll see how long this deleveraging cycle happens. What's interesting is that the three arrows from the Hayes piece is that three arrows started off, doing basically arbitrage as you described it. And I've always found the arbitrage in the space. I mean, we know that there's a famous story about SBF, Sam Bankman-Fried, who, started Alameda Research and did the kimchi trade, which is, basically, buying in the American market and selling in the Korean market and capturing 20% every day. But generally speaking, arbitrage in a high risk, high volatility market's kind of like picking up nickels in front of a freight train, right? You're capturing these risk-free returns, but you can get run over. And I think that's what happened, obviously, with these guys when they decided to get directionally long the market and, I don't know, eat their own pudding or whatever it's called, eat their own cooking. So yeah, we'll see. I don't know how long this is going to take to play out. Yeah, go ahead.
Sorry. Yeah, just one thing I want to quickly highlight also is, so Arthur has historically been a bit of a bear on Ethereum and crypto. He had a famous piece called Double Digit Crap Coin when he talked about Ethereum back in the day, back when it was, I think, $1,000, which is quite a call, first of all, to just essentially predict the 90% correction. But over the last 2 years, he's actually become quite bullish on Ethereum. We talked about how he put out essentially the offset piece talking about how Ethereum would go to 5 digits, so 10K. And in this article, he actually highlighted how DeFi has held up remarkably well during this three arrows collapse. And one of the things he sort of points to is because it's totally transparent. So because it's complete transparency, you as a depositor to the sort of DeFi protocol, there's not this uncertainty hanging over your head where you don't know what the loan book looks like, which then effectively means, which incentivizes people to pull their cash because they don't know when withdrawals will get gated. And then them pulling cash actually facilitates the bank run, which then collapses the whole thing. So what's interesting is because everything in DeFi is fully transparent, everyone can see that everyone can see the exposure. They can see that there's sort of no bad loans, or at least what the level of bad loans are. And so it allows people to not have to sort of proactively pull out funds from the protocols. And
even when they do, it's sort of the liquidations happen in an orderly manner. Because you don't have to worry about bad loans when all the loans are over collateralized, right? A lot of these protocols, as you point out, are completely transparent, open source, and that creates trust. And I think it's, during times of great strain when a lot of companies and entities, and these are sort of a new breed of entities, gets tested. And so far they've passed the test. It doesn't mean that their total value hasn't gone down or their users haven't. Some users haven't left. Those things may be true, but they have continued to, keep on during a period when a lot of centralized platforms, it feels like almost most centralized platforms, have had to take some steps to limit the damage. And in some cases, that damage has been pretty severe.
Yeah, exactly. And it's been interesting to see I guess it's probably been even though the total assets under DeFi protocols has declined dramatically from about, $250 billion down to about 80. So a more than 65% correction. I think DeFi's relative market share has actually increased during this correction, mostly as a function of a lot of these centralized lending platforms effectively collapsing. But I think that will actually stay. I think that in a weird way, while on an absolute basis, this has definitely hurt DeFi, on a relative basis, this has probably helped DeFi quite a bit. And so, yeah, I mean, I guess there's one glimmer of hope for DeFi protocols. And Arthur actually talks at the very end about how he's looking to buy DeFi protocol tokens like Compound, Aave, and MakerDAO, which is, again, a huge shift from sort of 2 years ago.
Absolutely. Yeah. Well, I mean, to me, it seems like yeah, I think that's the right approach. I don't want to provide any investment advice on the show, but whatever he's thinking seems sensible. So just to change the topic one more time, there's one thing we both wanted to talk about, which is that there's a well-known crypto entrepreneur and venture capitalist. His name is Balaji Srinivasan, who is better known just by his first name, Balaji, who's written a new book called The Network State. And I noticed they did a podcast with Tim Ferriss, but it was 4 hours long. And I'm like, I'm not going to listen to that 4-hour podcast. Maybe, on a long car ride or something. But I actually have read the original white paper blog post that he wrote, I think, which I guess inspired this book. It was, I think, back in November of last year, about the network state. And I don't think that the term, so basically the idea behind it, and it might even be helpful to just sort of read the précis of the paper. A network state is a social network with an agreed upon leader, an integrated cryptocurrency, a definite purpose, a sense of national consciousness, and a plan to crowdfund territory. And I think basically, I mean, this stuff, I think, a little bit better than I do. The idea is that we now have the networking technology, both with the internet as a communication medium and crypto as a value transfer medium, to actually organize capability and to organize people and resources into something coherent that has agency and has assets and has influence that starts to resemble a country. It doesn't have geographical borders, or at least not yet, though he provides examples of crowdfunding territory purchases. It doesn't have many of the same kinds of institutions. Wouldn't have a military. It doesn't have a military, or at least not yet. But there are these sort of building blocks which could help us to rethink the idea of a state or a nation. What are your thoughts on? I know you know a little bit about this stuff. What are your thoughts on that?
Yeah, no, I've actually listened to that podcast.
There you go. So I don't have to listen to it because you listen to it and you can just tell me. Give me the Coles notes.
Yeah, I've definitely listened to it. So Balaji is sort of the intellectual heir to this book called The Sovereign Individual, which came out in, I think, 1995 or even earlier, actually. And it essentially predicted the internet and crypto, among a number of other things. Some of the predictions were obviously wrong, but for the most part, it actually nailed a lot of the predictions, which was essentially saying that over time in a cyber economy, power to sort of regulate commerce will shift from physical sovereign states to the cyber economy itself. And he talks a lot about sort of money being like one of the first inventions of this, where if you had a fully decentralized digital currency that people could use, then they would, over time, people would shift more and more of their commerce towards that because it would be lower cost, more transparent, and just simply easier to use. So without getting too much into Balaji, because Balaji's book is like a 300-page book. He actually made it totally free online. I think at 1729.com. So you can actually read the whole book for free, or order the paperback via Amazon. But yeah, I mean, essentially what Balaji believes, and he actually, to give him credit, he wrote this, I think, 9 years ago in 2013. He did a whole talk about it. And essentially the idea is that more and more commerce will shift. It's actually very similar to Sovereign Individual. More and more commerce will shift online, to the point where those online communities will actually start to almost build their own geographically decentralized countries in a way. I don't know if country is the right word, but he calls them a network state. And more authority will shift to these network states as more and more commerce and more value is essentially created in these digital communities, to the point that these digital communities will start crowdsourcing actual physical land and become something that sort of resembles a country, but a far more decentralized, diffused country, because it won't have sort of strict borders. It will be more kind of people owning land all over the place. And I mean, he gives kind of like a 7-step sort of thing, 7-step roadmap, I should say, to how this will get achieved. The first step is you're going to have an online community of people creating startups, highly valuable startups that are going to be primarily in the crypto space, but he actually doesn't restrict it entirely there. These digital online communities of sort of startup founders who will organize into these collective groups. He calls them almost like a network union. So it's almost like a union, labor union, but of crypto and technology startups across the world. They will build trust online and as well as offline using sort of meetups. Again, this is kind of describing what a lot of crypto projects look like right now. And then over time, they will essentially, like I said, the founders who presumably will be controlling wealth will buy up land and almost form their own, they're almost like their own decentralized countries. The last part is where it sort of gets a little hazy, because I don't like the natural sort of criticism that right away boils up is how will that work within the confines of traditional countries? And I haven't read the book, so I'll just kind of paraphrase based on his talk, but he essentially predicts that a lot of the developed countries are slowly moving towards almost like a form of anarchy, because technology is just moving so fast, whereas sort of governments are not able to sort of operate at the same speed. And so you're getting this mismatch between sort of government capability and technology evolution. So, I mean, I have to read the whole book to give a more sort of better answer to the natural criticism that I'm even thinking right now as I sort of talk about it, which is like, how will these diffuse communities of digital millionaires and billionaires who are crowdsourcing land able to actually gain their own sort of diplomatic recognition as their own new country? Obviously, sovereignty is something that countries defend very vigorously.
Yeah, I think it's a question of, is this an actual prescriptive thing of where we're going, or is it metaphor for the power that technology tools have in rethinking, the world a little bit? Is the network state actually going to compete with other nation states that raise armies and have tax bases and, have institutions like police forces and education and highways and roads and so forth? Or is this more to point out that the old industrial age model of how we thought about society and how we thought about an economy and the idea of a nation state is perhaps reaching the end of its life cycle, and now we can rethink aspects of that using these tools. So having not read this book, having only read the initial sort of white paper in his Twitter and whatnot, I don't feel qualified to, say what he's exactly thinking, but I'd say it's probably more on this is actually going to potentially replace a lot of traditional nation states because of these inexorable forces that you're describing. Either way, it's a really interesting topic. Around the topic of governance too, like I know that you're a student and professor of governance and a builder of governance tools. So, how does, I don't know, we talk about futurarchy, this idea that, the tools that you're building at SX Network can be used to maybe make DAO governance a little bit better, more participatory, less corrupt. And cool, that's great for these little things called DAOs so far. But, if you think that these online communities are going to have their own native token with voting power to help control how resources get spent, it does start to look a lot more like, a company or even maybe like a small country. At what point do the tools that you've described and built even start to play a role in actually helping to enable something like the network state?
Yeah, I guess you actually just gave me an idea. I think the most
That's what I do. I just come up with questions and then you come up with the real ideas.
Yeah, so there's currently about $10 billion that is held in DAO treasuries across the entire crypto ecosystem. So if you imagine a world where crypto goes up another 100x over the next, say, 10 to 20 years, I think that's actually quite believable that could happen. So now instead of having sort of $10 billion in these DAO treasuries, you suddenly have a trillion or multiple trillions of dollars in DAO treasuries. Like theoretically, a DAO could go use a small part of its treasury and go and buy sort of land in the Bahamas or vacant land in some other country and negotiate almost like a special economic zone or even just like full on sovereignty. So in that sense, that actually does kind of provide a model of how Balaji's network state could theoretically work. It would probably target like very specific pieces of land, almost like a micronation to start, but that actually does make a lot of sense to me. One thing I also do want to point out, I sort of forgot to mention, is which is very prominent in the sovereign individual, and I think sort of glossing over network state, Balaji also talks about, is there's essentially diseconomies. So in the Industrial Revolution, there was huge economies of scale to governance and both commerce as well. And so it made sense to have a ton of people in your country because you can have more workers, which drive down costs, as well as sort of larger armies as well. And one of the things sort of pointed out in Sovereign Individual, and I think in the network state as well, is that there's now increasingly diseconomies of scale to governance. And one of the main reasons being that is that it's just so complex to govern sort of societies nowadays, given how fast things are moving from a technology perspective. And so that is kind of like the core argument for things like network states is governance effectively in the sort of as it is now has diseconomies of scale, which makes sense because I think for most people, when they think sort of federally, things seem a lot worse than sort of how things are working in their municipal cities. Like typically, at least from what I've seen, governance on the lower level seems to work better. And actually, Balaji talks a lot about that too, about how more and more power will shift to sort of cities. You'll get sort of city states. He talks a lot about Miami, obviously, because he's very bullish on Miami, and things like that, where essentially power will shift more and more to very adaptable sort of cities that are trying to encourage founders and stuff like that. I'm not totally sure on that as well, but yeah, I mean, I think the core sort of idea behind both these books is just diseconomies of scale to governance in a technology-first world.
Yeah. Well, it's an interesting idea. I'm gonna have to check it out. I'm so glad to hear it's free. Not all good things come for free, like Digital Asset Revolution, which you can only buy for $25 on Amazon.com, including work from me and Andrew Young. You get what you pay for. Don't forget that old saying. Sometimes there's value in putting money on the table. Anyway, that's to end on a shameless plug for our book. That was a really interesting conversation, Andrew. I wasn't totally sure where we were going to go today because so much is being driven by macro, but it's important to step back and think about some of these bigger, longer term trends that I think are driving a lot of innovation in the space. And I think maybe even more broadly are driving a lot of structural and societal change. Though it's hard to see when there's so much noise in the short term, it's clear of the direction I think that we're headed. All right, well, that concludes today's episode. Andrew, great to chat as always, and we will see everybody again next week. Thanks and take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.